In preparing for retirement, you may have heard of 401k accounts, health savings accounts, or HSAs, and individual retirement accounts, or IRAs. Each can play a crucial role in helping you plan for retirement. In this video, let's focus on the IRA accounts and the differences and advantages between them. There are two main types of IRAs, the traditional and the Roth. The traditional IRA allows you to contribute money that has not yet been taxed. This is considered pre-tax income. Once in the account, your money can grow tax deferred, but you will have to pay income taxes once you begin to withdraw funds later. A Roth IRA is where you contribute funds you've already paid taxes on. The upside to getting taxed before putting the money in is that your contributions grow in your account and you won't be taxed upon withdrawing the funds years later. Major difference between Roth IRA and traditional IRA. Taxes. The basic difference between these two accounts is on when you'll be taxed. With the Roth IRA, your funds will be taxed before you contribute to the account, while with the traditional IRA, your money is taxed at the point of your withdrawal from the fund. Your choice to make tax payment upfront or at withdrawal depends on one big idea. Will your income tax bracket be lower in the future? Your answer to this question will be a big determinant of if you use a traditional or Roth account. If you're in a high tax bracket now, but realize that your income generation will be greatly reduced later, thus putting you in a lower tax bracket, then the traditional IRA would be better, so that you can be taxed at a later date in a lower bracket. But if you believe that your tax bracket would be higher in the future, then getting taxed now would be most efficient, and putting after-tax money into a Roth makes sense. Early withdrawals. The magic age for withdrawals without penalties for all retirement accounts is 59 and a half. But life hits us all differently, and sometimes you'll need access to money in your retirement accounts. Though we typically strongly suggest not pulling money out of any retirement account until actually retired, one big advantage of the Roth IRA over its counterpart is flexible early withdrawals. Since you contribute to Roth IRA with funds you've already paid taxes on, you can withdraw your contributions, but not any gains, free without penalties, as long as it's been in the account over 5 years. Why is this? Remember, you contributed to your Roth IRA with after-tax money, so taxes have already been paid on your contributions. Be careful though, because you'll incur penalties if you try and withdraw the gains or earnings that your money accumulated. With the traditional IRA, you can only withdraw without penalty after you turn 59 and a half. Though you can make early withdrawals, you'll be hit with income taxes, and most times you'll have to pay a 10% early withdrawal penalty to the IRS. Lastly, Roth IRAs have an additional potential advantage over traditional IRAs. Since you can pull your contributed amount early from the account, some may utilize their Roth IRA as an emergency fund. Once again, we typically suggest that you build your emergency fund and put it in a high-yield savings account, but life happens, and these funds could be there for you in the event you need some extra cash. Required minimum distributions. Required minimum distributions, also known as RMDs, are mandatory yearly withdrawals. At the time of this video, the age where this is required to start is 72 years old. Traditional IRA accounts, and typically all traditional types of retirement accounts, have an RMD requirement, while Roth accounts don't have required minimum distributions. The reasoning for this is simple. You are not taxed on your money in a traditional account until you withdraw. The US government wants to be able to tax you at some point, so it requires you to begin to withdraw at a specific age. Since Roth accounts are funded with post-tax dollars, you're not under obligation to spend the money in your Roth. The opportunity to ignore compulsory withdrawal is one very big advantage you'll enjoy with a Roth IRA. Income limits. While anyone can open and contribute to a traditional IRA, regardless of your annual income, income limits can prevent you from contributing to Roth IRAs. For you to contribute to a Roth IRA directly as of 2022, you must make less than $144,000, and for married filing jointly, that number is $214,000. This was initially put in place so that highly paid employees were not afforded more benefit than the average earner from the tax advantages the account provided. Also note, there's no limit to how much can be contributed to a traditional IRA. Not everyone can deduct their entire contribution from their taxable income, as this is determined by you and your spouse's income level as appropriate. We've talked about some of the differences between the two, but there are commonalities as well. There are rules and advantages to investing in an IRA, regardless of whether you choose the Roth or traditional route. Tax-free investments growth. Roth and traditional IRAs both come with tax-free investment growth, meaning you'll have paid the tax before or you'll pay it later upon withdrawal. But while the money is growing in your account, it is not being taxed. This allows your money to grow and compound for many years and decades if you allow it. This is awesome because in a normal investment brokerage account, you will have to pay taxes each time you sell an investment and make a gain or each time you receive a dividend. Allowing your money time to compound without taxation strengthens your path toward wealth and financial freedom. Total contribution deadlines and limits. You can contribute money to your retirement account so long as you have taxable income. This is important. Annual contribution limits are the same for both Roth and traditional IRAs. As of 2022, this limit is $6,000. If you are 50 years or older, you can contribute an additional $1,000 in catch-up contributions. Now that we've discussed the two accounts, you may be wondering which option is best for you. To be able to answer that, you need to ask yourself a question. Does it make the most sense to be taxed now or later? When you answer that question, you can choose the IRA type that will give you the best tax savings. That's because if you expect lower tax rates in retirement, you can choose a traditional IRA that comes with an upfront tax advantage, while if you think that rate will be higher in retirement, you can choose a Roth IRA with its delayed tax benefits. Remember that Roth IRA contributions are not tax deductible when you withdraw. If you're in a seemingly low tax bracket now, you're probably going to save more money in the long run by being taxed now and putting the funds into a Roth IRA. But with a moderate to high tax bracket now, then traditional IRA tax savings contributions could be the better way for you. So a traditional IRA has the upfront tax break over the Roth, and it also has no income limit, meaning regardless of how much money you make, you can contribute to this account. For high-income earners or those looking to reduce their tax income, it is effectively cheaper to save for retirement as tax savings each year reduce your contribution, but you will be taxed in retirement. In contrast, the Roth IRA means you'll be taxed now, but your contributions and the earnings it makes will grow tax-free and will not be taxed upon withdrawal when you retire. Both IRAs can be very good options for retirement savings. No matter which one you decide to go with, the sooner you begin to invest and put the compounding interest rate power to work for you, the better off you'll be in retirement. Tell us, do you currently contribute to an IRA? Which did you choose? If you learned something new today, like this video and share it with your friends. Make sure you subscribe to our channel and click on that bell icon to get notified when we drop more content. See you in the next one.